See him filter. I'm going to go ahead and get this kicked off. I'm sure we'll have a few more join. Thank you, everybody, for joining us today. Today we have Kyle Richards and Jason Cole from Future Standard who are going to present. Kyle might look familiar. He's been at Hershey a few times. Future Standard, formerly known as FS Investments, has been a great partner of the Premier Network Group over the years. And Kyle told me a few months ago, I got this guy, Jason, fantastic speaker. He talks about global policy and where things are headed. I know from going to the Cambridge events that those are always well attended, well received sessions when they do them as keynote topics. So we wanted to do it specifically for the Premier Group. So without further ado, I'll turn it over to Kyle. And if you want to do Jason's intro, you guys can take it from there.
That's perfect. Thank you, Sebastian. Thank you, everyone. Politics aren't really topical right now, right? It's one of those things. This is right for a sleepy, rainy kind of Wednesday. But Jason has a ton of great content, and I'll get to him to a second. But first and foremost, thanks for spending some time with us today. I hope you all had a great Memorial Day weekend. Thank you to those who have served and those that have family that have served. We really obviously appreciate that. As Sebastian mentioned, my name is Kyle Richards. I'm with our business development team, and it's always great to be in front of this group, especially since you're mostly not too far from me. So I'm in the Philadelphia area where we're located. Future Standard has partnered with Premier for a long time now, as Sebastian had mentioned, and we appreciate not only your time but your trust. There's many of you that have used our solutions in the past, and it's not completely lost on us that there's a lot of sponsors out there that are vying for your attention. So that's something obviously we always like to start with. But I do want to spend a few minutes on a kind of a growth idea before we get to Jason. It's been resonating across the country with high net worth clients as well as business owner clients, and that's middle market private companies. They're the backbone of the U.S. economy, and they're largely unrepresented in portfolios today. It's comprised of about, call it 200,000 companies. It employs nearly about 50 million Americans. And if you look to it just by itself, it's the third largest standalone economy in the world. And interesting, private companies in total, they represent about 96% of the investable equity universe. And most folks are just getting into that 4%. So why private middle market companies? They're attractive because they really represent growth at a reasonable price, or GARP. It's a way to diversify beyond the tech AI trade, where you see the majority of public returns are coming today from a few names. And largely the names that, we see in our portfolios, they're not household names, but you've been impacted by them daily. Given that Premier is largely centered in the Pennsylvania, Maryland area, most of you have been on the Pennsylvania Turnpike. So when you look at the Pennsylvania Turnpike and you're driving along and you see those mountains, right? We own the company that was largely responsible for clearing the way and getting the road set for the Pennsylvania Turnpike. As you continue along, you'll see that there's those big concrete bollards and dividers on the highway. You go a little bit further, you see the giant concrete pipes that are typically getting ready to be buried for drainage. We own that company. It's called Lindsay Precast. And then if you stop at one of the service areas along the way and you grab a cold beverage out of the refrigerator, we own the company that does all the refrigeration in trucks and in convenience stores for Coke and Pepsi products. So again, these aren't snazzy big name companies that you're going to see and hear about a lot, but they touch you on a largely, daily occurrence. And these are companies that are family owned for generations. They get larger and larger. They've seen growth over the decades, and they haven't really taken outside capital. So that's something we like to call taking the first bite of the apple as these companies start to grow and expand and look to take on private capital for the very first time. So the fund that I'm, referencing to all this that can take advantage of the space is FSMVP. I know some of the folks on the call have probably already used it at this point. It consistently provides you high levels of growth, right around that kind of low teen target retirement or target range. And then it's done about 13% annually since inception. And it's done it with about a quarter of the public equity market volatility. So less volatility than what you're getting in public equities, a way to diversify across and away from the AI tech trade and do it, with really kind of nice multiples. So in closing, before, we get to the main event here, there's a large contingent of your wealthiest clients. They've achieved their wealth through either owning, operating, or selling a private business. And the irony typically is when you get that money, that capital is redirected into the public equity markets. This is a story that resonates with those folks because this is a way for them to invest in companies that are not too dissimilar from the ones that they have used to build their wealth. So, with that, we always appreciate the opportunity to connect with you afterwards. I know my colleagues will be doing that as well. Please just give us a couple minutes just to talk to you. This is not about every one of your clients. This is about some of those 3, 5, 10 top clients that are really going to make an impact with them because this is something that's going to generate consistent returns over time. So, let me move on to my friend as well as colleague Jason Cole. Jason is kind enough to indulge me from time to time, but you can imagine over the last 2+ years, he's been rather busy. And a lot of his time is spent in Washington, understanding the political climate. He's spent his entire career there in various levels of the federal and state governments. But what Jason's going to do today is run through a presentation that talks a little bit more about the things that are impacting your clients' lives and portfolios kind of daily now from taxes, tariffs, inflation, what's happening with the Fed, geopolitical environment, war across the world. So he has a presentation that's going to run for the next, call it 30, 40 minutes, but we're going to make sure that we leave time for Q&A because there's always a healthy amount of questions given what's going on in the world today. So Jason Cole is our head of public policy. And Jason, please take it from here.
Kyle, thanks so much for the introduction. Kyle, if you could confirm that the screen share is working.
Yes, it is. The pendulum
Super,
swings.
super, wonderful. Thanks everybody for your time. Kyle, thanks for the introduction. As Kyle mentioned, I lead public policy. That's a nice phrase for I am future standards lobbyist down in Washington, D.C. I've been at the intersection of policy and politics for almost 30 years now. I did a dozen years on Capitol Hill, lobbied for UBS, lobbied for MetLife, and now with Future Standard. My stints on the Hill were both with two members of Congress, both of whom served on the Financial Services Committee. So my background is in financial services policy, and I'm delighted to be with you all here today. And I'm glad and grateful that you've taken time out of your schedules to sit through this. As Kyle mentioned, I'm going to run through a few observations. I'm going to start with we're having a hard time advancing. I'm going to start with an observation about where we are this year. The market has been bludgeoned with just a raft of headlines since the beginning of 2026. This is just a small representation of the things we've seen starting all the way back on January 3rd with Venezuela. We had Greenland. We had an investigation into the Federal Reserve Board chairman. We had the president's signature economic policy through tariffs overturned by the Supreme Court, and now we're engaged in a conflict, war, imbroglio, whatever we want to call it, in the Middle East. And yet, through all of this, you can see that the market, at least as measured by the S&P, has largely shrugged this off. It's up roughly 9% from the beginning of the year after a glut of the news. But I would remark that throughout all of this, one thing to monitor here is that dark black line, and that is the 10-year yield. If I were to chart the 10-year back into last year, you would see a spike above that dotted line, 4.5%, around Liberation Day in early April of 2025. And you saw a retreat from policy there. I would argue that the 10-year, and as sort of the big headline and everything I'm going to talk about today, is the thing to watch when you're thinking about policy coming out of Washington and as actually being the policy governor. You can see late March this year, the 10-year started creeping toward that dotted line. That was when we had the very first signal out of the administration that, hey, maybe we need to begin dialing back the efforts in Iran. You've had fits and starts throughout the month of April and here into May, leading into last weekend where there were signals potentially of another deal in the offing. We'll talk about that in a moment. And because the 10-year began creeping and in fact exceeded that 4.5% margin. And so I think that's something here to watch as a policy governor, at least from this administration. I know for a fact that Treasury Secretary Besson is really dialed into that number. And as investors, it's something I think for everybody to pay attention to. So with this as a backdrop, I'm going to talk about maybe five policy themes that I see dominating the rest of this year and maybe even further down the road when we get into numbers four and five. Number one, the elephant in the room is Iran. Two, what I believe to be continued uncertainty around tariff policy. Three, the midterm elections just 159 days away, not that I'm counting. And the politics of affordability that are surrounding those midterms, which will drive some interesting policy debates and outcomes potentially. Debt and deficit, which is an increasing argument, particularly as we see yields rise over the last month or so, that has begun entering the equation more and more in the conversation, more and more. And then finally, I want to talk a little bit about private credit. It's come up in a lot of topics or conversations I've had over the last months with investors, and there is a Washington angle on this that I want to share with you all. So, without further ado, we'll move into Iran. On Iran, I want to start with a big disclaimer, and that is everything I'm about ready to say is influenced by what I digest through a lot of news sources and through conversations with the administration and other officials on Capitol Hill and in Washington. I would say, however, that about three people, and that's probably too many, actually know what's going on with Iran in the world today. The news media, please understand that that is used by all of the actors involved here, and there are at least three, probably many more, to drive agendas, to speak to one another. And so there's going to be inherent biases in sort of that coverage, depending on what coverage you're reading. But this is sort of my take on the situation in Iran today. One, taking a big step back, I think it's important to look at the goals of again, at least three parties involved: the United States, Israel, and the Iranian regime. The Israeli or the Iranian goal here is very simple. It is have the sun come up tomorrow and the next day and the day after that. It is severe. It's simply survival. The Israeli objective here is the exact opposite of that. It is the total and absolute elimination of the regime as it exists today. Ours is a little different, and I think it's morphed over time more toward the Israelis, but it is open the Strait of Hormuz and it is get rid of the Iranians' nuclear capacity and ability to build a nuclear weapon. I would argue that those two things probably ultimately mean that the regime has to be upended down the road. And as if you look at what we have done with the Israelis since the beginning of this conflict on February 28th, we began with a decapitation regime to get rid of that regime and command and control sector. We did that pretty effectively. It has, of course, been replaced. That is the issue with Iran and has been the issue with Iran for 47 years, is that it is a multi-headed hydra of leadership, kind of like the five families in New York City. And once you whack one, a new one comes up. And so this has been an ongoing challenge here. We moved very quickly from that decapitation campaign into a degradation campaign, targeting their air defenses, their offensive capacity, their internal security apparatus. Reports are that that has largely been successful, although there are some contradictory reports over recent weeks that maybe the Iranians maintain more of that offensive capacity and defensive capacity than we actually realize. And the third piece is that we have now, I think, very clearly pivoted, at least the United States, and this is where the United States and Israel have begun diverging. But we have pivoted to a de-escalation and diplomatic campaign, again, to reopen the Strait of Hormuz and eliminate the Iranians' nuclear program. The Iranians have responded very early on with an attrition campaign, and that was simply to inflict maximum pain on the Gulf states, take advantage of the asymmetries, the huge ones in munitions with $20,000 drones fighting $4 million Patriot missiles, and they're trying to exact a war premium through effective control of the strait. They did that rather effectively and have forced us into a naval blockade. And now I think the Iranians are content to avoid addressing sort of our key concerns in an effort to sort of kick the can down the road. So they can ultimately amortize their strategic costs, rebuild their proxy networks, and potentially move military assets around without fully committing to a deal. This is frustrating the president. The president desperately wants an off ramp again ahead of 159 days ahead of a midterm election that where this conflict and its attendant costs on energy prices and other things are weighing very much on the electorate. And I'm not, and I think you see him trying to get there, but you continue to see the Iranians avoid. My view on this is that ultimately, with the Iranians' goal of survival, they have zero incentive to deal on Hormuz, and they have zero incentive to deal on the nuclear capacity because those are the only 2 points of leverage they have in order to ensure their survival in the long term. Accordingly, I'm not sure we're going to see a deal. We'll maybe continue to see bopping headlines like we did on Friday and over the weekend. And then ultimately, the bombing began again on Monday. And so I think that we may be in for a prolonged conflict here. And even if there is a deal, I would warn you as investors that to question whether or not the Strait of Hormuz is ultimately fully and unambiguously open. To the degree that the existing regime is in place, even with a handshake or written agreement that will open the strait, they maintain the ability to mine. Maintain the ability to fly drones into carriers or into cargo ships transiting that strait. And to the degree that MSC, Maersk, their insurers, or anybody wanting to conduct commercial activity in that body of the water believes there is risk, then moving commercial cargo through that body of water will carry a risk premium. I don't know what that is, 20, 30, 40%, but there will be a risk premium insofar as that regime maintains in place. And that will weigh on ultimately long-term oil markets, potentially other equity markets if those costs of inputs start moving through, and ultimately weigh on sentiment. And I think that's something for investors to pay attention to. Moving on to trade and tariffs, staying on the international front, everybody will recall on February 20th, the Supreme Court overruled a portion, and I want to underscore a portion of President Trump's tariff regime. Most of the headlines hailed tariffs are dead, and I argued long live tariffs. Why? Because one, the president is immensely committed to this policy. This is a true social post of his not long after the Supreme Court announced their decision, where he indicated a staunch position that he's going to move forward with the tariff policy. Two, only about half of the tariff policy was affected by the Supreme Court decision. There was about 1.5 to 1.8 trillion dollars worth of imports that have been tariffed under Section 232, which and 232 says grants the president great authority to do this. They weren't the subject of the Supreme Court decision, and they're tariffs on a lot of products: aluminum, steel, copper, pharmaceuticals. They're all listed here, and those tariffs remain, and they are not affected, and they will absolutely remain in effect as long as the president is president of the United States. Thirdly, the president has other options post the Supreme Court decision, namely those first two that are working in concert right now. Section 122 of the Trade Act enables the president to levy tariffs up to 15%, 1.5, for 150 days. Those tariffs are in effect. They went into effect about 4 hours after the Supreme Court decision. They went into effect at 10%. We'll get to the reasons why in a moment. There's the ability for them to go to 15. I don't think that they will. And that will be in effect until late July, July 24th, as a matter of fact. In the meantime, the administration is using the second bullet here, Section 301 of the Trade Act, to conduct investigations on 60 countries, most of which are our largest trading partners, into their trade activities in order to make the case to increase tariffs on them and to replace the IEEPA regime with the Section 301 regime. Those investigations will be completed late July, early August, no later than into the third quarter. Arguably, the tariff regime that was built all of last year, where we saw an effective average tariff rate of about 19%, that wall is being rebuilt and it will be completed by the end of the third quarter. If you believe that I do, that tariffs are a tax on consumers and that they will ultimately be passed through to consumers through price increases, you arguably, as investors, and I'll let you figure that out, whether or not those inflationary effects will kick in and whether we're going to start seeing that in equity markets in the third, fourth quarter of this year. I think that we will. I'm not sure how much it will be, but I think it's something to pay attention to, that the tariff story hasn't gone away. One other piece of uncertainty here, and I referenced the 10%. Under the current 122 regime, the administration has gone down to 10% on all countries. They have the ability to go to 15. I don't believe they did because the United States had a deal with the UK at 10. And the way that statute is written, it says it has to be uniformly applied across all countries in the nation. And so the Brits, you'll recall, were over here recently. I'm told had some conversations with the president and said, "Hey, we can't have you go to 15 because we have a deal at 10." And I don't think we're going to go to 10, go to 15 because the Brits have successfully convinced the president to stick with the deal, and accordingly, the 10% rate has to be applied uniformly across all countries. It doesn't matter anyway. That will go away on July 24th. And my concern around uncertainty is whether some of the deals we've struck are at risk if we start seeing Section 301 tariffs increase rates beyond the deal rate that the president struck with many of these countries over the last year. If those deals are at risk, that means less investment coming into the United States, one, and two, it means the potential that the potential for the tariff tweet from the president comes back again. In fact, we've already seen this. We saw it about 2 weeks ago when the Europeans were dragging their feet on the deal and failed to ratify it, and the president said, "I'm going to do 25% instead of 15 on your autos." The Europeans last week ratified their deal, and so no harm, no foul. My point here is that the uncertainty around the tariff tweet, I think, rises again once we get past these 301 investigations, and I think it's something for investors to pay attention to. These two issues, Iran and tariffs, are international in focus, and they largely don't address the concerns of voters today, as we again are 159 days ahead of a midterm election. The Economist last week, and they poll this every week, and for every week for the last 3 years, inflation and jobs in the economy have been the number one issue on the minds of voters. Today, they're over 40%, and if you add healthcare, arguably an economic issue, half of voters have concerns about economic policy. They will argue in another poll, this one admittedly on the right-hand side here, was done in January before Iran. Voters don't believe the administration is doing enough to lower prices, and they believe the administration is focusing too much on tariffs and activities overseas. And so the two preceding issues run entirely contrary to where voters say they want the attention by policymakers focused. Notwithstanding the fact we continue to have discussions about Iran, we continue to have discussions around maybe Cuba, and we continue to have discussions around tariffs and not on inflation, jobs in the economy, and the core issues that are facing voters, which is my third point, the politics of affordability in the midterm elections. Do not sleep on the possibility for this issue of affordability to become a very hot one in November's election campaign, and the potential for it to create a raft of policy proposals that are very populist in nature, and to be very blunt, and they'll come from the left and the right, and to be very blunt, will largely be really dumb ideas. Voters are saying they are very concerned, and large majorities, are concerned about the price of everyday items, gasoline, electricity, their consumer goods, housing, and healthcare. We've seen the administration address this on food with some very quiet exemptions on the tariff policies, with food products for which we do not have good substitutes. Think bananas, think coffee. Tariff restrictions were lifted on those products back in December. It was done very quietly because it trampled all over the administration's message generally around tariffs. I think you also begin to see policies around on healthcare. You've already seen the rollout of the prescription drug most favored nation status and the Trump RX. That is an idea to bring prescription costs down. In housing, we've seen proposals floated to increase the 30-year mortgage to a 50-year mortgage. We've seen proposals to ban institutional investors from buying up single-family homes. These are the institutions, by the way, who found a price floor back in 2008, 2009. We've seen proposals out of left-wing proposals to cap rent, and we've seen not even a proposal but an actual action to increase mortgage-backed security purchases by about $200 billion. I would describe that as a shadow QE. It was done by the Federal Housing Finance Board back in January, and it did have the intended effect of bending the long end of the curve, at least temporarily. On the consumer finance side, we've seen proposals to cap credit card interest, which is probably not a great idea for anybody with a FICO score under 700 who will never get a credit card again. And then on the energy space, the issues are clear. When you have a constricted supply, we're beginning to see proposals to suspend the gas tax, both at the state and federal level. I hope actually permitting reform may come along so we can move more energy projects online. And the big one here for investors is this data center moratoria. And I want to focus on this for a minute because if you believe, like I do, and I think the data bears this out, that the AI trade has been the dominant feature buoying this economy and buoying that market that we showed on the first slide for the better part of a year and a half, if not 2 years. I believe that could be increasingly at risk if you understand that the whole foundation of that, the data center, is at risk. It's not at risk because the capital doesn't exist. The capital is there, I have no doubt. What's becoming increasingly clear is that the political will to build data centers is waning all over the country. This is not a blue state problem. This is not a red state problem. There is a bipartisan consensus around NIMBYism, around increased energy costs that data centers allegedly drive, and around water concerns that data centers allegedly have that are driving a very strong and powerful political narrative to shut down data centers. In the fourth quarter of 2025, there were 42 data center starts around the country stopped. About $150 billion worth of investment ended in the fourth quarter. In the first quarter of this year, it was another 49 data centers around the country. This is happening again in red states. It's happening in blue states. And the cost of data centers is going up. And so if you're investing in infrastructure funds on this digital infrastructure space, be wary and be diligent about what you're looking into and whether or not you're being asked to finance the land acquisition. If you are run, the land needs to be purchased, the land needs to be zoned, the land needs to be properly permitted, and I would argue that the data center company needs to be bringing its own power. Those are four necessary conditions for these things to get built, and if they aren't done, I'm not sure the starts will happen. Each of those conditions will increase the ROI on the deal. And there's a fifth condition that I would be worried about, and it's whether or not the data center builder has guys like me on the ground building community support for this. And what's that mean? That means that the days of states and local governments giving away tax benefits for data center buildouts are probably over. And instead, the politicians are showing up and saying, hey, I need you to hook up my school. I need you to build me a park. I need you to hook up my hospital, whatever the case may be. The point is that no longer do you get a tax benefit and you have to provide other benefits to the local community, all of which reduce the ROI on the deal. It's something to pay attention to as we move forward around this politics of affordability. I promise you it is becoming an increasingly toxic issue politically. Kyle mentioned to me that most of you are from Pennsylvania, New Jersey area. You saw this in the governor's race in New Jersey in 2025. You really saw it where I hail from down in the DC area in the governor's race in Virginia, where the entire messaging was around data centers in Loudoun County, probably the data center capital of the world, where I would argue not another data center is going to get built. And so this is something that's a very salient political issue and something to watch out for ahead of the midterms. So what about those midterms? If you are a Republican, here's my headline, running for office, you need to begin paying attention. The political environment for Republicans right now isn't great. That is not a partisan statement. That is a fact. One, when you look at the generic congressional ballot, and that's what many people like me do when we head into midterms, and that is the question that pollsters ask, generically without naming a candidate, would you rather have a Democrat representing you or a Republican representing you? The generic congressional ballot today is about 7% in favor of Democrats. Now, in a congressional race, particularly in House races, Democrats historically need to be leading on that by about 2 or 3, sometimes 4 points, because Democrats' votes are not efficiently allocated. They tend to be concentrated in urban areas. And so when you're doing national question about generic ballot, the oversample here are Democrats usually is about 3 or 4 points. So let's assume that the generic congressional today favors Democrats by about 3, just to be very conservative here. The second thing I would look at when I'm looking at the political environment is what are the special elections that have happened since the last national election? There have been 7 congressional special elections across the country. A couple of these were people stepping down to run for governor in Virginia, New Jersey. A couple of folks died. In those Florida races, they were people that got tapped for President Trump's administration. In every one of those races since last November 2024, the Democrat candidate overperformed Kamala Harris's performance in 2024 by an average of 9 points. That's a measure of an intensity. That tells me that Democrats are very energized and ecstatic about voting. And when you look further down the ballot or down into special elections, there have been over 100 oops, I didn't mean to do that. There have been over 100 at sort of the state house, county commission level since last November. In 89 of those, the Democrat outperformed Harris by an average of 13 points. Again, that is a measure of an intensity. And again, to be very safe and because I'm not great at math, we'll take the 3-point generic congressional, divide the overperformance by 2, and say it's about a 10-point margin that Democrats have right now heading into the midterms. In other words, if you're a Republican who won in 2024 by less than 10 points, you should begin paying attention, raising money, going home and campaigning because your seat is at risk. Now, what does this all mean when we get into the nuts and bolts of these races? Looking at the Senate, only a third of the Senate seats are up for re-election. Republicans are defending more places than
ASKJ
Democrats.
Life Portal
I'm sorry?
931702.
Dave,
Hey,
mute yourself.
David Edwards, could you mute, please? Thank you.
Jody, there we go.
So when you look at the Senate battleground, you have Republicans defending about 2 times as many as seats as Democrats. Democrats here need 4 seats in order to flip control of the Senate. I don't think they will do that. When I'm looking objectively at this map, and you sort of look at these bars on the right here, you can see there's really only 3 seats where there are flip possibilities. Michigan is a seat that a Democrat is holding that actually Trump won. And so if you're a Democrat, you worry about losing Michigan. If you're a Democrat, you actually worry about losing Georgia. It's a state Trump won. I don't think they'll lose in Georgia. They have a very good candidate down there. Democrats could lose in Michigan. There's a terrible primary that they have going on, and Republicans have a pretty decent candidate. And when you look over on the other side of seats that Republicans are holding, Maine is at risk for a Republican, Susan Collins. She has historically been very difficult to beat. She is akin to an electoral cockroach. I mean, she cannot be killed. And the Democrats, in my opinion, have an extraordinarily flawed candidate up in Maine. So it's not certain to me that they can pick up that seat. The only one on this board that is within that 10-point margin of error, if you're a Republican, is North Carolina. And it's the only one that I have a high level of confidence the Democrats flip. I think when this is all said and done, Democrats probably net 2 seats out of the Senate, but I don't see 4, and I don't see the Senate flipping in this cycle, and that it will stay in Republican hands. Over in the House, today, more or less, there are some vacancies right now, but if everybody were in office right now, Republicans hold effectively a 3-seat majority. They're 220 to 215. When everybody's president and voting, it takes 218 to pass legislation. And so that implies a three seats that Democrats need three seats in order to, or four seats in order to flip the House. I do think they will do this with a relatively high level of confidence right now. There's some mitigating factors I'll get to in a minute, and really it's history. The president's party in power, on average, loses 21 seats in the House in the midterm. Again, Democrats only need four. And so just the historical averages here suggest to me that Democrats have a pretty good chance of flipping the House. That and the whole sort of political environment that Republicans are operating in not being great adds to those chances. Now, if you're a Republican, there is a mitigating factor. The first one is that there just aren't that many seats left that are actually competitive. There's 35 total under my estimation. 18 of these are true toss-ups. 14 of those 18 are represented by Republicans. Four are represented by Democrats. And then when you look at sort of what's been going on around the country with respect to redistricting, I think Republicans can pad their three-seat margin by another 8 to 10 seats. So let's call it 12 seats where that Democrats need to get in order to flip the House with where only 18 are toss-ups. You're getting into inside straight territory. It's not quite there, but it's becoming increasingly difficult. And if I were talking to you guys 6 months ago, I would have said 95% chance Democrats take the House back. But this redistricting effort has really tilted the scales to benefit Republicans in a way that may allow them to take control of the House. If you're making me assign a Cauchy bet on it, I would say 70 to 75% that it flips. It's not nearly as high as where I was, 3, 4, 5, 6 months ago. I do think so. I do think the House flips and the Senate stays in Republican hands, which means we end up in divided government in 2027. In my experience, markets love divided government because it means gridlock and not a whole lot can happen. It also probably means that you'll see more tweeting activity from the president and you'll see more executive action from the president, all of which will go to the courts, some of which will be upheld, some of which won't, and we'll sort of be in an enhanced period that we've seen the last 2 years with a lot of executive action coming out of the White House. If you want sort of the indicator for how the House midterms are go, I'll take you back to college stats and the R squared. Look at the president approval rating. That is the biggest determinant of how House and Senate midterm outcomes. Right now, the president's sitting roughly at 39%. This is in the historic danger zone of bad approval ratings that dictate the potential for there to be relatively large losses for Republicans in the House and Senate. But again, you can see back in 22, Biden was about the same place that Trump is today. Only lost 9 seats in the House. That again is a function of there just aren't that many competitive seats left. And so the numbers on the board here and the number of seats that are up for the taking just aren't that many, and it's going to be hand-to-hand combat in about 30 places across the country. Moving on to the fourth longer term sort of thing for, I think, investors to pay attention to, and that is the federal budget deficit and debt. And I've been getting an increasing number of questions on this with investors, so I decided to include it. And I think it's probably due to the fact that we, about 2 months ago, eclipsed for the first time since World War II, 100% of debt to GDP ratio. The national debt now is about 31 plus trillion dollars. You'll hear 39. That 39 represents, that delta is money that the government owes itself. The 31 trillion plus is money the government owes other people, bondholders, pension funds, so on and so forth. And so I think of it about 31 trillion. The GDP is about 31 trillion. We have eclipsed that now and our 100% debt to GDP ratio. That is when people begin getting worried and you begin having conversations around the debt and the deficit. One thing I like to point out to folks is that those two pullouts on that donut chart, defense and non-defense discretionary, is roughly a quarter of the entire federal budget. That is what Congress controls. That is what Congress votes on every year. They're roughly equal. Defense and non-defense discretionary is literally everything. Healthcare, education, roads, all that stuff is non-defense discretionary. Everything else in the donut is mandatory. It's on autopilot. And it would require congressional action to make significant adjustments. And it is those things that are inside the donut that are driving the growth of the national debt. Explosive growth in Social Security, explosive growth in Medicare and Medicaid, and the interest on the debt is getting bigger and bigger and bigger every year as rates stay higher for longer. And these things are going to require massive political will and to get under control. And I think there are a couple of conditions necessary for that. Number one is divided government. So we aren't there today. We might be there in January. And number two is presidential leadership. And number three is sort of a burbling up from the people that, hey, we need to get this fixed. And if you look at the bar charts on the other side of the graph, nobody's in the mood to cut spending on any of these programs. In fact, large majorities say we want to increase spending by a lot or slightly. The only places where the voters today are willing to cut are in defense and foreign aid. Everything else, voters would like to see more spending on. And so today, there's an entire disconnect between what the voters want and what sort of the balance sheet is beginning to demand and what I think bondholders are beginning to demand. And I think as investors, it's something to pay attention to because ultimately, this picture adds up to higher rates for much longer. And as you're looking at sort of the 10-year and the 30-year, this is going to be a big driver in the next not months but years, and something to pay attention to. And politicians are going to have to grapple with it. My final point, and then we'll open it with questions, and that's around private credit because I've been getting a lot of questions on this and want to share some observations coming out of Washington. I've been doing this for 30 years, and in those 30 years, I've cultivated a lot of relationships with the reporters. It's useful to me to learn things from them, but it's also useful for me to plant narratives in their minds that where these stories ultimately get written. And I think the private credit story is largely a media narrative that's being driven by banks. And when I take a step in the Wayback Machine to 2023, 24, I look at a proposal that the Fed put out to implement what they call Basel III that would have, in the aggregate, raised capital on the large money center banks by about 20% in different buckets. The bank lobby got to work as they should have, and they're very good. They're all friends of mine. They went to the Hill and they lobbied their allies in the Hill and got them to throw sand into the gears of the Fed's effort, and they managed to delay that rulemaking until after the election. And when the election happened, the Fed put its pens down and went back to work under a new vice chair of supervision, where they released a proposal back in March, about 2 months ago, that would have, in the aggregate, reduced capital on the large money center banks by about 2.5%. That's a good return on your investment, on your lobbying investment. If I was a lobbyist for a big bank, that's what I would be putting in front of my CEO as that we managed a very good return here. In addition to that, there have been other efforts among the regulators. There was a $13 billion capital release through changes to the enhanced leverage ratio. And in December, importantly, the OCC and FDIC rescinded guidance that the Obama administration introduced post GFC that really restricted banks' ability to lend, at least lend economically and do high yield corporate loans. That guidance was rescinded, and since then, you've seen banks move back into this market. In fact, when you look here, the lending from large institutions has remained relatively flat until December, where you began to see a lot of lending activity coming through the large commercial banks into the leverage lending space. Simultaneous to that, you saw drip, drip, drip of news stories around how dangerous private credit is. When I'm on the Hill talking to members of the Senate Banking Committee and House Financial Services Committee, I begin hearing from members, "Ooh, tell me more about private credit. Is it systemic?" and so on and so forth. And I began scratching my head, where is this coming from? Well, talking to my reporter friends, it's coming from the banks. And I joke that I'm an older brother. When my mom, on the rare occasions, would make pie, I would beat my little brother up in order to get a bigger piece of pie. And I think that's what's happening here, where you have banks driving negative narratives around private credit because they stand to get market share back in this space. When you think about credit overall as a piece of pie, a healthy credit market in the United States has roughly been 20 to 25% of GDP. That's all credit, corporate, household, consumer debt, so on and so forth. When we have gotten in trouble historically, it's migrated up to 40, 50, 60%. Today, we're at 23. We're right down the middle of the fairway. The pie hasn't grown. It's grown along with the size of the economy. The only number you see in these news stories is the big scary 2 trillion, but that $2 trillion in private credit debt is in that larger piece of the pie that again is growing along with the economy. And I would argue that there's a strong media narrative being driven here to help banks get market share back. I'm not going to sit here and say that private credit isn't that there aren't bad loans, but I would say that as investors that you should be diligent and look at vintage 2020, 2021 before rates reset. That those might not be great funds, but anything written in 24, 25 after the rate reset and so on and so forth, I think probably looks pretty good. And we have a negative media narrative driving this story. We've got about 10 minutes. I'm going to stop and see if there's questions from the group here.
Thanks, Jason. I got distracted. What was your takeaway on Iran? Where do you think things go from here with that whole
I
situation?
think we're going to continue in this sort of ebb and flow of deal, no deal, and the Iranians just continuing to play this avoidance strategy. It doesn't feel to me like they have any incentive to give up anything on the Strait or on the Iranian nuclear deal. And the MOU that was sort of at least the details that leaked over the weekend, you know, that says, hey, we're going to open the Strait. Maybe the United States unfreezes some assets while we talk about nuclear. That's an opportunity for the Iranians not only to move oil out and get paid for, but also have their assets unfrozen or some of their assets unfrozen and get paid for. It doesn't seem like a great deal to me. Right now with the blockade, again, my disclaimer on news reports, the Iranians are anywhere from 2 weeks to 2 months away from exhausting their ability to offload the oil they're pumping, right? And if they have to start turning off production, I'm not a Texas oil guy. I don't, but I've heard that it is very expensive to turn those pumps back on, and it can be very damaging if you shut them off. And so, if they get to a point where they can't offload oil, that they are now at a decision tree. And my argument would be, look, if I were advising the president, I would say, let's wait this out, keep the blockade in place, and see if we can squeeze them economically enough to make them legitimately and meaningfully come to the table. The problem is we have 159 days to elections, and increasing oil prices, increasing market uncertainty and jitters, particularly in the bond market. They don't have to worry about pesky elections, right? They don't have voters that they have to deal with, and frankly they don't care about whether or not their people suffer economically. And so there is a huge disconnect between, an autocracy and a democracy and what each side is able to, sustain in terms of pain.
Yeah.
And
I
that
have,
just taking all that all together, I just think we continue in this cycle of deal no deal that
yeah.
we've seen for the last 6 or 8 weeks now.
Great. Thank you. A follow-up question for me is, and once again, like you said, this isn't meant to be partisan, but I mean, we all know how Trump is. Is the talk? Do you get the sense Trump actually cares what happens in the midterm? Is there anything on his to-do sheet that he's still
Yeah,
do? Like, what's your sense there?
so I honestly don't know that he cares about the House, right? I do think he cares about the Senate for a couple of, so I think his attitude is on the House. Look, you guys have impeached me twice. Do it again. And both, oh, by the way, both times you did it, it made me stronger. So go for it, right? You do what you're going to do and impeach me and on off to the races. So I don't think he much cares about where the House goes. The Senate, however, I do think he cares about that for two reasons. One is that that impeachment, as you know, goes to the Senate for a conviction, and so losing that and starting to bleed out more, we'll just call them, for lack of a better word, moderate Trump skeptical Republican senators. There aren't many of them, but there could be enough, in the right scenario to convict. I don't think there ever will be, but I do think he cares about it for that. More importantly, I think he cares because the Senate has to confirm nominees, and the Senate has to confirm potentially a Supreme Court or two justices. There are rampant rumors in DC right now that there are efforts to push Alito out in advance of the election. And by the way, this is the other reason you're seeing. The Majority Leader Thune has whispered to the White House that, look, if you want to make changes to your cabinet, do them now. So there is sufficient worry on the part of Republican senators that there is a probability that frankly increases daily that they lose the Senate. And so it's like let's make sure we get everything set for the next 2 years before the elections. Make sense?
Yep.
So I do
Thank
think
you.
he's worried. But in terms of policy, I mean, the Congress has really, and for all intents and purposes, done one bill in 2 years. That one big beautiful bill where everything from the president's agenda was in that. The tax cuts, there was a slug of defense spending, there was a slug of immigration spending, there was a slug of energy spending, and there was a slug of ag spending in that bill. And so that was a big chunk of the president's agenda and everything else he's done from executive order. And he's very comfortable doing that. And so I'm not sure he cares much about the House and Congress passing legislation and him signing it.
Got it. Thank you. Anybody else? Tom, looks
Hi,
like maybe you
Tom.
want to.
Yeah, I have a couple. So maybe you don't want to answer this, and then I'll ask, hopefully not too charged a question, but I'm just curious about what you would say. So, in listening to your opinions about things, are you bearish or bullish, or you just think it's volatile?
I think it's volatile. I think the Mideast situation again. I think is ongoing. It's probably came through. I'm not a fan of tariffs. I do think they're a tax on consumers, and I do think they continue to inject uncertainty into business investment decisions that may or may not be made because of that uncertainty. But overall, look, I am an optimist. I do hold a lot of hope out. We didn't talk a lot about AI. AI simultaneously excites me and scares the bejesus out of me. The whole Mythos release flap of what was that, about a month ago, when Mythos reached out to 40 or so people and said, here's a sneak peek. We're worried. What wasn't largely reported on was about 2 days after that, most of the bank CEOs were in DC for a trade association meeting. Besant pulled them all in and had a very strong conversation about Mythos. There is a palpable concern in the administration around that. There are efforts underway and you may see an executive order in the next weeks or months from the administration saying, hey, we may need to get a sneak peek at this stuff before you put it into the wild. And so there's some stuff about AI that scares me. The stuff that excites me, however, is its potential around, advancements in medicine that frankly, if we could cure cancer and diabetes, holy smokes, that kind of solves that debt Medicare problem, right? Which it's those chronic diseases that are really driving up costs and creating hockey stick growth in those cost curves. So, yeah, but I do think it needs to be monitored. I would not have been surprised at a high level, and I'm wouldn't be surprised if it leaks that they talked about it in China. But I do think the AI is getting to a point where the two countries on the planet that have access to the Chinese and United States need to begin having conversations around controlling it.
I,
This is the 21st century nuclear bomb.
I,
If we're not, if we don't put the right guardrails around it.
before you leave the first subject, I am startled, me personally, that the market doesn't seem to want to price in some of the downside risks of the things that you've articulated. They're just kind of chasing chasing the tech AI headline, and that just seems to placate them. Okay, so then my other more scary question is, how would the market react to a contested election result?
Um, I'm not sure you're going to get a contested result in the 2026 midterms. And the reason for that is you have 435 House races, 34 Senate races. Um, you can't, neither party can win them, right? You're going to win some, you're going to lose some. It's going to be about 50-50. And there might be some recounts and whatnot in a handful of those,
Or I guess
but I think in 2028,
the more
2028,
fundamental question is the market going to react to um, a scenario where sort of the basic democracy culture of the United States looks like it's sort of in danger, or it's screwed up. It's like we actually cannot, we actually can't, we're effectively in a civil war. I'm glad that, the AI is going on, but effectively we're so mad at each other that we can't function.
yeah, I'm not sure that. So on the market side of it, I'm not sure how the market ultimately reacts to that one. Although there are some signals, I would argue, and I'd love to if you want to, we can get you my contact. I'd be delighted
Yeah,
to
I
talk to
live
you
in
about it
DC,
more.
so we can have
No, but
lunch.
I'd be delighted to talk to you about it more. But I would argue that, we've already seen. I hate this redistricting stuff. I think it's destructive on both sides.
Yeah,
And the markets look through that. And I do have some ideas, and I do think we're at a tipping point where or close to a tipping point where people are going to begin demanding electoral reform around redistricting, around open and closed primaries, around a whole host of things. And it may take a little bit more egregious activity on the part of both
right,
parties because they're both acting egregiously here
right.
to reach that tipping point. But I think we're close to it, and that would be great. Um, but again, if you believe like I do that the redistricting stuff is not great for democracy, the markets look totally through that. But we can have somebody get my contact, and
Yeah,
I'd be
like I said,
delighted. If you're in DC, I'd be delighted to sit down and have a cup of
yeah,
coffee. Yeah,
we can have coffee.
yeah.
Okay, cool.
Any other questions? I know we're at
Yeah,
time,
yeah,
but
one more. Let's do a bonus question here if you guys are good from Jim Williams.
absolutely. Hey,
Hey,
Jim.
hey, Jason, thank you very much. This is great information. Um, this is just really specific. I heard you say something about Loudoun County. Um, I have a client that was approached about 4 years ago to sell a big chunk of land for this purpose,
Yep.
and it hasn't happened yet. Were you saying that it's likely another data center isn't going to be built in Loudoun County?
Uh, I I don't know. I mean, if he's able to sell his land at a premium, I would sell the land um, at a premium. But I'm not sure the land. I'm not sure the data center ultimately gets built on it. So it's the best of both worlds. He gets paid and doesn't have a big box on his land.
What?
I say that tongue in cheek. Here's my story. I'll tell you on this one. In mid to late October, I had breakfast with Senator Warner, who's a senior senator from Virginia.
Right, Mark Warner.
He, of course, he's in cycle now, but he was commenting on the governor's race that was very hot then. Look, most guys like me thought Abigail Spanberger would win by 3 or 4 points, and she won by 14. And her whole campaign was really focused on affordability generally, but affordability as it relates to the data centers very specifically. And when I was talking to Senator Warner, if you know anything about Mark Warner, before he was in public service, he built cell phone towers. So sort of the 1980s, 90s data centers. He's extraordinarily familiar with, I tell you that because he's extraordinarily familiar with the politics of NIMBY around those things. And my guess, and so he made a lot of money, tens if not hundreds of millions of dollars in this space. It wouldn't surprise me if he's an investor in the data center stuff because he's dialed into that sort of tech sphere. And he looked at me then and he's like, Jason, I don't think there's ever going to be a data center built in Loudoun County again.
Mm.
And that was this positive statement, Jim, not a political one, right? Of just this is the environment right now. It's really ugly and very difficult to get these things built.
Well, he
Um,
was my client was in an uphill battle with local politics, with
yeah,
local
this is all local.
committees
This
and
is all local right
commissioners.
now.
So
This is all local problem right now.
yeah, okay.
Yeah,
Thank you very much. Appreciate it.
yeah.
Good. We're over
Great.
time here, so I just want to say thank you to Jason and Kyle from Future Standard. Great presentation, great information. Tom, I'll work with Kyle to connect you to Jason offline here. But thanks again, guys. We appreciate you doing this and the support for the Premier Network Group. And with that, everybody enjoy the rest of your day.
Thanks
Thanks
again.
all. Take care. All right. Bye-bye.